Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Welcome back to the channel, traders and investors. Today, we're diving deep into a fascinating microcap stock that has recently popped up on our hard-to-borrow screener, CCTG International Holdings Limited, trading under the ticker CCTG. This isn't just a generic exploration, we're going to dissect CCTG specific numbers, what makes it hard to borrow, and what those eye-watering cost-to-borrow fees actually mean for the potential of a short squeeze. Show CCTG logo/chart. Let's get straight into it. CCTG International Holdings Limited, CCTG, operates in the industrial sector, specifically within electrical equipment and parts. This company designs, manufactures, and sells interconnect products globally, serving Europe, Asia, and the Americas. With a current market capitalization of just $3.06 million, CCTG is firmly in microcap territory, often a hotbed for volatility. Looking at the recent price action, CCTG has been on a tear. Today alone, the stock is up a significant 28.53%. Over the last 5 trading days, it's gained 16.82%, and zooming out to the last 30 days, CCTG has rallied an impressive 54.24%. This upward momentum is certainly catching eyes. In terms of volume, today's trading saw 25,797,700 shares change hands, which is 2.4 times its 30-day average volume of 10,862,816 shares. High relative volume like this often signals increased interest and potential for continuation. What is cost to borrow and why it matters? Before we get further into CCTG, let's quickly clarify what cost to borrow means, especially for those new to this concept. When a short seller wants to bet against a stock, they first need to borrow shares from a broker. There's a fee associated with this loan, much like interest on a regular loan. This is the cost to borrow, or CTB. If a stock is hard to borrow, it means there's high demand to short the stock or a very limited supply of shares available to lend out. When demand outstrips supply, the cost to borrow fees can skyrocket, often exceeding 100% on an annualized basis, sometimes even much higher. These high fees are a significant signal that short sellers are paying a premium for their bearish bets. Why this stock is hard to borrow right now. Highlight CTB numbers on screen. Now, let's look at CCTG through this lens. CCTG has appeared on our hard-to-borrow screener for some very specific reasons. The annualized cost to borrow fee for CCTG currently stands at a staggering 678.2%. Think about that, nearly 7 times the value of the borrowed shares, paid annually, just to hold a short position. While the CTB momentum has seen a minus 28 percentage point change over the last 5 trading days, indicating a slight moderation from potentially even higher peaks, this fee is still astronomically high, signaling extreme demand to short the stock despite the cost. Furthermore, there are currently only about 10,000 shares available to borrow. When you compare this to CCTG's estimated float of 3.0 million shares, you can see how incredibly tight the supply is. This combination of an extremely high CTB fee and a minuscule number of available shares to borrow is exactly what alerts us to a potential squeeze setup. Our internal composite squeeze score for CCTG sits at 45.1, which is a moderate score, indicating a situation worth monitoring, but not yet a full-blown squeeze in progress. Squeeze mechanics explained. So, what does this all mean for a potential short squeeze? A short squeeze occurs when the price of a stock begins to rise, forcing short sellers to buy back shares to close their positions and limit their losses. This buying action further pushes the price up, creating a snowball effect. In a stock like CCTG, with such a limited supply of borrowable shares and extremely high CTB fees, short sellers are under immense pressure. Every day they remain short, they're paying that exorbitant 678.2% fee. If the stock price continues to climb, the CCTGs has in recent days, the urgency to cover intensifies. A shrinking supply of borrowable shares means it's harder and more expensive for new short sellers to enter, and for existing ones to add to their positions or even just to maintain them without feeling the squeeze. However, it's crucial to remember that a high cost to borrow does not guarantee a squeeze. It can also mean short sellers have strong conviction in their bearish thesis and are willing to pay the premium to stay short. Dilution risk check. Show screen with no dilution risk found. One critical factor to consider when evaluating any potential squeeze candidate is dilution risk. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This typically dilutes the value of existing shares and can completely negate or offset a short squeeze thesis, even when the cost to borrow is high, because it provides more shares for short sellers to cover with or for new shorts to enter. For CCTG, we've checked recent SEC filings and found no recent dilutive SEC filings such as SMIN S1, SMIN S3, or 424B forms in the last 90 days. We also found no recent reverse split for CCTG in our look-back window. This means that, currently, dilution does not appear to be an immediate concern for CCTG, which is a positive sign for any short squeeze thesis. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, what should you watch for with CCSC Technology International Holdings Limited, CCTG, moving forward? Keep a close eye on the cost to borrow fees. Any sustained increases or stabilization at these high levels will maintain pressure on short sellers. Also, monitor the number of shares available to borrow. If that already tiny supply of 10,000 shares continues to shrink, it further tightens the noose. Of course, volume is key. Continued high relative volume, especially on green days, can signal growing buyer interest. Finally, observe the price action. Sustained upward movement and breakouts through key technical resistance levels would be crucial indicators that short sellers may be feeling the heat. CCTG presents a compelling case study of a hard-to-borrow stock in the industrial sector, specifically electrical equipment and parts. With its microcap status, a staggering 678.2% annualized cost to borrow, and a critically low supply of shares available to short, the mechanics for a potential short squeeze are certainly in play. The absence of recent dilution risk is also noteworthy. However, always remember the balanced perspective: high CTB doesn't guarantee a squeeze. It simply tells us that betting against this company is extremely expensive right now. As always, this is not financial advice. Do your own thorough due diligence. If you found this deep dive into CCTG insightful, please hit that like button, subscribe for more in-depth stock analysis, and let us know your thoughts on CCTG in the comments below. We love hearing from you.